Hello, Casey Cooper here with Cadent Capital's Economic Update in the fall of 2023. I appreciate you joining us today. We want to give a quick update on our similar video newsletter from the fall of 2022. In that video, we talked about the pressures that had led to inflation that had at that time peaked at around 9% year over year coming out of this summer of 22. Our views were that inflation pressures were much less on a go-forward basis at that point in time. And sure enough, we've experienced a substantial decline in inflation, now sitting at around 4% for both headline and core inflation. Core inflation is simply headline or all-in items, but it includes food and energy, which can be volatile and a little bit noisy in data. So core typically is more useful from an economic analysis perspective. We want to revisit that because the reasons that there was pressure a year ago that was dissipating, we've experienced it, and simply want to give an update and look forward to be instructive over the next year, as ultimately we're trying to see where do we want to be from a risk perspective in portfolios. We'll touch on that more in just a moment. The 5 factors that we talked about fit into a neat little acronym, CHOOSE. That's consumer spending, housing, energy, wages, and supply chain. And really, I cheated a little bit. The S stood for supply and material chains. But each of those had been facing substantial pressure going through late 21 through the summer of 22, and were unlikely to continue. Energy, we noted at that time, was one that could continue if Russia's invasion of Ukraine and the disruption of energy availability in Europe could lead to another leg, which did not materialize, or at least not to a cataclysmic level. Now, of course, we have a new conflict in the Middle East, or a new old conflict in the Middle East that is creating a pressure. But energy has normalized to a point that we no longer think it will be as noisy as it was over the last 3 years, commencing with COVID. Consumer spending is really the factor that we are most anticipating will be the driver of either inflation heating back up or cooling down in the next year. Simply put, we have been anticipating now for about 6 months that as we gain distance from stimulus, we would see consumer spending cool down. And it is in pockets, but it's not yet pervasive enough that we have seen the GDP of the US or the value of all goods and services that are sold slow down. And it's really no surprise, given consumer spending drives about 75% of GDP. But we anxiously await the fourth quarter earnings reports and holiday spending, as we have seen the lower 10 to 20% of consumers in terms of their wealth and income. They have experienced really a normalization of delinquencies on auto loans, credit card loans, and mortgages. But the rate that they're increasing at, those delinquencies, is alarming. Not alarming that it's clearly a problem, but alarming that if that rate continues, it will quickly become one. And the problem that would become is taking a leg out of consumer spending. And if that were to decline, we believe that the broad resilience of the economy is no longer strong enough to keep us out of a recession. The reasons that this lower portion of the consumer base is facing pressure is because, generally speaking, they're the ones that had less slack to begin with. This is the group that benefited most from stimulus. And then, unfortunately, many of them kept the spending party going with credit. And following the Silicon Valley Bank debacle early this year and the banking mini crisis, lending environment is tighter. And as we continue to gain distance from stimulus, it's natural that we're now seeing these delinquencies pick up. But the extra leg that we're, worried about from this perspective is student loan payments restarting likely has a big overlap with those that are already economically exposed. So that's not a political viewpoint on should they or should they not start. It's just a economic viewpoint on this could be finally a catalyst for consumer spending to decline. But I don't think it would actually be consumer spending declining because of them directly. It would be the more responsible portion of consumers that look at that and get fearful and worry about the recession that's to come. And I say that in air quotes here, the recession to come, but could make it self-fulfilling. If enough people view that a recession is coming and stop spending, almost certainly we'll have one. Wage pressures, supply chain, These generally are in a healthy place. We think they won't be very noisy for the next year, thankfully. Unemployment remains low, supply chain and inventory levels are getting very healthy. Certainly we can find examples that go against that, but broadly speaking, they're no longer strong pressures. So really it's that consumer spending dynamic that we're anxiously awaiting. What happens through the fourth quarter with holiday spend? Will we see tepid results, or will we still have surprisingly stubborn positive spend by the collective consumer in the U.S.? In any event, we believe either the high rate environment that we're in, or maybe this consumer spending downturn that could be, or it could just be a shoe dropping out of left field, as always, could lead to a recession. Our viewpoint is that one in the next 12 to 18 months, the chances of it are higher than the average economist seems to be predicting. However, we're not overly fearful about the portfolio impacts of a recession. We already experienced an asset valuation reset in 2022 with virtually all major assets down substantially, even touching bear market territory for equities. And we've had a recent pullback in equities, giving back some of the gains that we experienced in the recovery of asset values this year. So we're not in bubble territory for assets. Should shield us from having the downward pressure on markets if a recession comes forward, again, barring it being a significant geopolitical event out of left field that we can't sit here and predict today. More interesting to us is the bond side of the portfolio. Bonds are typically used to manage volatility, or at least they're classically used that way. Over the last few years, bonds have been every bit as volatile as equities, at least on a relative basis. And really it's been a tennis match between investors and the Fed and Chairman Powell. Chairman Powell has proven to be a reliable narrator as he has tried and his cohort has tried to corral inflation and made that priority one. They have been very stubborn about continuing to increase rates as they've said they would until economic data suggests that we've overcome it. With core inflation still around 4%, clearly the job is not done yet on that front. However, he did recently state that with market rates moving higher, especially on the long end of the Treasury curve, maybe market rates are doing his job for him. It doesn't change the fact that we have an elevated rate environment, and the elevated rate environment itself chokes out growth from the economy and could be a reason that we kick into a recession, even if it's a shallow one and a short-lived one. Nonetheless, it could be showing that maybe now, instead of there being a tennis match between investors and the Powell, both fighting against each other, maybe they're now a doubles partner. Maybe they're now fighting the same direction, which would reduce, in effect, volatility for the bond side of the portfolio. With yields higher in bonds at a level that we haven't seen in 15 years, if we can have the risk side of bonds decrease even slightly, the risk-reward trade-off of the bond side of the portfolio is very attractive today. Simply put, we're excited about it. That doesn't mean to say that we don't like the prospect of equities long-term. We're not overly fearful of a significant decline if that recession does come to fruition, a decline in equity markets from this level, but the risk-reward trade-off of bonds is simply more attractive than the risk-reward trade-off of equities. So we are starting to tilt back away from equities, but only to our neutral point. We're simply no longer tilting to equities away from bonds for those that don't desire already to have a high equity allocation. So just know that'll be a discussion that we have with you over the next 6 to 9 months if we haven't already done so in the last few. But as always, if you have any questions about how our viewpoint impacts your portfolio or any concerns you have about the economy, please do not hesitate to reach out. Thank you very much.